concept of negative compounding in investing. Imagine having a golden goose, but instead of laying golden eggs, it occasionally takes some back. That's negative compounding in the world of investing. It's a sneaky villain that can creep up on you and your hard-earned money if you're not cautious. Let's unravel this concept with some real-world examples to understand its impact better. Negative compounding unveiled. So, what exactly is negative compounding? It's when you lose potential gains from what could have been compounded earnings. While a positive return can boost your portfolio, a negative return can pull it down, and sometimes even more drastically. Example 1, the SeeSaw Effect. Take an investor who starts with $1,000. If they gain 20% their first year, their investment grows to $1,200. Great, right? But if they lose 20% in the next year, it dips to $960, not the original $1,000. And this cycle of gain and loss continues for 20 years. Even though it seems like they'd be breaking even annually, they would end up with just $664.83, a true eye-opener. Example 2, the jumping bean mistake. Negative compounding isn't just about market fluctuations, it's about our reactions to them. Let's say an investor gets cold feet seeing an underperforming stock or fund and jumps to another investment. But what if their timing is off and they miss out on a rebound? They have locked in their losses and missed out on potential gains. Let's delve into another stark example of negative compounding, one that really emphasizes its potential impact. This example is often cited to illuminate the challenges of recovering from significant losses in investing. The 50% loss scenario. Imagine you have an investment worth $1,000. Unfortunately, due to unforeseen market downturns, you experience a 50% loss. This means your investment value is now halved, leaving you with $500. Now here's the concept of negative compounding becomes truly eye-opening. To recover from this 50% loss and get back to your original investment of $1,000, you don't need a 50% gain. Instead, you need a whopping 100% gain on your remaining $500 just to break even. To illustrate, $500, your current investment rate after the loss, plus 100% of $500, a $500 gain is $1,000, your original investment. This example underscores the gravity of significant investment losses and the uphill battle to recover. It's a testament to the importance of risk management and understanding the math behind investment gains and losses. Investing is as much about wealth creation as it is about wealth preservation. Here in this chart has more info on what it takes to recover from losses with negative compounding. To explain further, after a 10% loss, $10,000, you're left with $90,000. To get back to $100,000, you need to earn $10,000 on your $90,000 investment, which is an 11.11% return. After a 20% loss, $20,000, you're left with $80,000. To get back to $100,000, you need to earn $20,000 on your $80,000 investment, which is a 25% return, and so on. The pitfall of interrupting compounding. Sometimes we're our own worst enemies. If an investor pulls money out, maybe due to a panic in the market drop or for any other reason, they interrupt the magic of compounding. This means they're not just losing current value, but all future compounded growth. Staying steady in the storm. So, how do we guard against this silent portfolio eroder? Start investing early, understand your investments thoroughly, and resist the urge to interrupt compounding without valid reasons. Techniques like employing trailing stops can also help in capturing some profits and minimizing losses. The world of investing is filled with ups and downs. While we can't predict every twist and turn, understanding concepts like negative compounding prepares us to make better decisions. As we wrap this up, remember it's not just about gains, but ensuring we minimize these hidden drains on our investments. So are you ready to be more vigilant and informed investor? Diversification, spreading the risk. One way to mitigate the impact of negative compounding is diversification. Think of it as not putting all your eggs in one basket. If one investment dips, others might rise, creating a balanced effect on your portfolio. Position sizing. Have you ever been captivated by the allure of high-reward investments? Those tantalizing prospects that promise substantial returns yet come with a higher risk tag? While these can be thrilling, they can also bring devastating setbacks if not approached with caution. Today, let's explore the strategy of smaller position sizing for these riskier investments and understand how it shields our aggregate portfolio from the perils of negative compounding. Understand position sizing. Position sizing is all about determining how much or what percentage of your portfolio you'll allocate to a particular investment. Think of it like this. If you're embarking on a treacherous mountain hike, you wouldn't put all of your supplies in one bag in case it gets lost or damaged. Similarly, for riskier investments, you wouldn't want to risk a major chunk of your portfolio. The domino effect of large positions. Imagine having 50% of your portfolio in a high-risk investment. A significant downturn could severely hamper your entire portfolio's health. And we've learned from the concept of negative compounding, recovering from such a dip would require even heftier positive returns, putting additional pressure on the remaining investments to perform exceptionally well. Benefits of smaller position sizing. Mitigating losses. By allocating only a smaller portion of your portfolio to riskier bets, you ensure that potential losses are contained, protecting the bulk of your investments. Flexibility. With a diverse portfolio, you have a leeway to adjust, reinvest, or even exit positions without massive repercussions on your overall portfolio's health. Emotional equilibrium. Smaller stakes and high-risk investments means less emotional stress during market volatility, allowing for clearer, more rational decision-making. Consistent contributions. The power of dollar-cost averaging. By consistently adding to your investments, regardless of market conditions, you can average out the purchase price over time. This method, known as dollar-cost averaging, can help neutralize the effects of market volatility and lessen the sting of negative compounding. Understanding market cycles. Markets have their seasons, booms and busts, and everything in between. By recognizing these patterns and understanding the markets move in cycles, investors can avoid making impulsive decisions based on short-term losses. The value of long-term vision. Rome wasn't built in a day, and neither are great investment portfolios. Having a long-term perspective can help investors ride out the inevitable market downturns and benefit from the overall upward trajectory of markets over extended periods. To wrap things up, while negative compounding might sound daunting, armed with knowledge and a well-thought-out strategy, you can navigate the choppy waters of investing with confidence. Investing isn't just about recognizing opportunities, but about managing risks and understanding the nuances that impact your wealth. Stay tuned as we dive into adaptive strategies in our next discussion. Until then, equip yourself, stay informed, and keep your financial goals in clear sight. Thanks for sticking with us at Wythdrawl Investing Insights. Please like and subscribe our channel for more videos like this. Remember, this is not to be construed as financial advice, and you should always consult a financial advisor. Past performance is not indicative of future results.